theory, central banks must raise interest rates above the level of inflation to effectively combat rising prices and restore confidence in the currency. This fundamental principle rests on the assumption that higher interest rates will discourage borrowing and spending, thereby cooling off inflationary pressures. However, this notion is met with skepticism, particularly given the multifaceted factors influencing the current economic landscape. Economists and policymakers frequently assert that inflation will decrease, yet they rarely articulate a coherent strategy for how this will be achieved. The reality on the ground is stark, with food prices soaring, fertilizer costs skyrocketing, and widespread crop shortages affecting supply chains. The prospect of reducing inflation appears nearly impossible. This grim scenario raises serious questions about the efficacy of central bank policies and whether they can genuinely address the root causes of inflation. Historically, central banks have employed various tools to manage inflation, including adjusting interest rates and implementing quantitative easing (QE). However, the effectiveness of these measures has diminished over time, particularly since the financial crisis of 2008. The repeated attempts to raise interest rates have not only resulted in failure, but have also exposed the vulnerabilities in our financial system. For example, after the 2008 crisis, the Federal Reserve maintained near-zero interest rates for an extended period to stimulate economic growth. When inflation began to rise, the Fed's attempts to tighten monetary policy were met with significant resistance from various economic sectors, revealing the delicate balance central banks must navigate. Moreover, the persistent failure to address inflation underscores the complexity of the economic challenges we face. It is not merely a matter of raising rates. The interplay between various economic factors, including supply chain disruptions, labor market constraints, and geopolitical tensions, complicates the situation. Recent geopolitical events such as trade disputes and the war in Ukraine have exacerbated supply chain issues, driving up costs and contributing to inflation. These multifaceted influences render simplistic solutions inadequate, requiring a more nuanced understanding of the global economy. Despite the ongoing turmoil, central banks are under immense pressure to act in a way that preserves their credibility. Historically, any central bank's attempts to raise interest rates since the financial crisis of 2008 have resulted in failure. This consistent failure highlights a troubling trend. The strategies employed by these institutions have not only proven ineffective, but have also led to disastrous consequences for the global economy. For instance, in the aftermath of the 2008 crisis, central banks around the world resorted to unprecedented levels of QE, flooding the economy with liquidity. While this policy temporarily boosted asset prices, it failed to translate into sustained economic growth or improved living standards for the average citizen. The disconnect between policymakers and the citizens they serve is palpable, leading many to question whether the same people who orchestrated the crisis can lead us to a solution. The situation is further complicated by the emergence of Central Bank Digital Currencies, CBDCs, as a proposed remedy to the economic challenges we face. Proponents argue that CBDCs could modernize the financial system, enhance efficiency, and provide better control over monetary policy. However, upon closer examination, it becomes evident that the rationale behind their creation primarily serves to manage existing debt rather than addressing systemic economic issues. The question arises, how can we justify the establishment of CBDCs when they appear to be merely another mechanism for perpetuating a cycle of increasing debt? In advanced economies, the predominant strategy for alleviating this burden involves hyperinflation, an insidious process where debts are effectively diminished through the issuance of currency that ultimately loses its value. This approach raises ethical concerns about the long-term implications for citizens who will inevitably bear the brunt of this inflationary burden. Moreover, the notion of hyperinflation is not a far-fetched idea, but a historical reality. Countries like Zimbabwe and Venezuela have experienced extreme cases of hyperinflation, leading to the collapse of their currencies and devastating impacts on their economies. The lessons learned from these experiences highlight the fragility of fiat currencies and the potential consequences of reckless monetary policies. As central banks grapple with the specter of inflation, the historical precedent serves as a stark reminder of the importance of fiscal responsibility and prudent monetary policy. In addition, recent headlines have revealed a shocking level of inflation that seems to have caught central banks off guard. Reports of rising prices for essential goods and services, coupled with supply chain disruptions and labor shortages, have led to a growing sense of unease among consumers and businesses alike.
The persistent surprise and shock experienced by policymakers reflect a fundamental disconnect between the realities faced by everyday citizens and the decision-makers in financial institutions.
It seems that, as human beings, we tend to assume that those in power possess a nuanced understanding of economic dynamics. However, it appears that central bank officials are not as astute as they ought to be. Their decisions reveal a troubling lack of foresight and understanding. As we approach the end of the economic cycle, purchasing power in various currencies, whether it be the Australian dollar, the euro, or the US dollar, has dwindled to alarming levels. This phenomenon is not accidental. It is a deliberate design that aims to obscure the gradual erosion of our financial well-being. The average citizen is often unaware of the extent to which inflation erodes their purchasing power. For instance, when individuals go to the grocery store and find that their usual basket of goods has suddenly increased in price, they may not fully grasp the long-term implications of this inflationary pressure on their savings and overall economic stability. In this context, it is crucial to recognize that central banks, rather than being infallible experts, are simply individuals tasked with maintaining a facade of stability. Their focus appears to be more on managing public perception than on implementing sound economic policies. At the crux of the issue is the monetary policy tool that has been employed to control the inflation rate, interest rates. Central banks aim to tighten monetary policy by raising interest rates, which, in theory, should slow down borrowing and spending. The underlying assumption is that higher rates will discourage borrowing and, consequently, cool off an overheating economy. Conversely, when economic growth stalls, they lower interest rates to stimulate borrowing and spending. This push-pull dynamic, however, has led to diminishing returns. Each round of quantitative easing QE seems to require an increasingly larger infusion of capital to achieve the same effects, primarily manifesting as asset price inflation, rather than genuine economic growth. When examining the broader financial landscape, one can observe the disproportionate rise in asset values, particularly in real estate. For instance, in many urban areas, housing prices have skyrocketed, creating significant barriers for first-time homebuyers and low-income families. This phenomenon raises concerns about affordability and accessibility within the housing market. The issue is compounded by the fact that many individuals are unable to participate in the housing market due to exorbitant prices. As a result, a generation is increasingly becoming renters rather than homeowners, leading to a broader conversation about wealth inequality and the long-term implications for economic mobility. This phenomenon is not merely a symptom of a housing crisis. It is indicative of deeper structural issues within the economy. It is essential to clarify that this inflation is not necessarily indicative of a healthy economy. Rather, it reflects the depreciation of fiat currency. For instance, when gold prices rise, many people erroneously perceive it as an increase in value, rather than recognizing it as a response to the declining value of the dollar or other fiat currencies. This nominal confusion contributes to a pervasive misunderstanding of the underlying economic dynamics. Additionally, the reliance on fiat currencies raises questions about the long-term sustainability of such systems, especially in light of growing public skepticism toward central banks and their policies. Gold has been considered a reliable form of money for thousands of years, transcending the need for a central bank's endorsement. Its intrinsic value has stood the test of time, maintaining a broad base of buyers due to its utility and history as a store of value. The unique attribute of gold is that it carries zero counterparty risk, a feature that no other financial asset can claim. Given these characteristics, central banks have a vested interest in dissuading individuals from holding physical gold and silver. The possession of tangible assets limits their ability to exert control over individuals' wealth, and thus, the inflation tax becomes an insidious mechanism for wealth redistribution. This taxation mechanism operates stealthily. Governments can inflate the currency without the need for legislative action, thereby minimizing public awareness of the financial burden imposed on citizens. This strategy allows governments to extract wealth without overtly appearing to tax citizens, as inflation diminishes the value of money in circulation. The psychological implications of this mechanism are profound. as individuals unwittingly consent to their wealth being eroded through inflationary policies. The consequence is a gradual transfer of wealth from the general populace to the elite, perpetuating cycles of inequality that are increasingly difficult to break. Moreover, corporations benefit significantly from this arrangement. When inflation occurs, it allows corporations to reduce the real wages paid to employees. For example, if an employee is accustomed to earning $20 an hour, they are unlikely to accept a reduction to $10 an hour. However, if inflation is rampant and the purchasing power of that $20 decreases to the equivalent of $10, corporations effectively pay their employees less without the need for direct wage cuts. This dynamic has contributed to staggering levels of income inequality, wherein the average CEO compensation has ballooned compared to the wages of the average worker. In 1971, the ratio was approximately 20:1. Today, it hovers around 380:1. This disparity highlights the structural issues within our economic system that perpetuate wealth concentration. Historically, the gold standard served as a crucial mechanism for instilling fiscal discipline in governments. It constrained their ability to print money at will, compelling them to be responsible stewards of the economy. This reliance on a commodity-backed currency forced governments to consider the long-term implications of their monetary policies. The gold standard not only served as a safeguard against rampant inflation, but also ensured that economic growth was sustainable. The abandonment of this system has paved the way for a cycle of economic instability, marked by booms and busts, as policymakers attempt to navigate the complexities of modern finance. As we look to the future, it is essential to recognize the possibility of a significant shift in the economic landscape. The ongoing disconnect between overvalued real estate and undervalued precious metals, like gold and silver, suggests that we may be on the precipice of a dramatic reversal. If current trends persist, what once required 100 ounces of gold to purchase property may dwindle to a mere fraction of that amount in a hyperinflationary environment. The implications of this transition extend beyond individual investors. They speak to the broader health of the economy and the need for a reevaluation of our financial systems. Furthermore, the utility of gold and silver extends far beyond their roles as investments. These metals are integral to numerous industries, including manufacturing, medicine, and technology. The versatility of precious metals highlights their intrinsic value, reinforcing the argument for their importance in times of crisis. Unlike assets that rely on a single buyer, gold and silver possess inherent demand across various sectors. This fundamental characteristic ensures that, during economic upheaval, there remains a steady demand for these metals, making them more resilient than other financial assets. In conclusion, the current economic landscape presents a myriad of challenges, exacerbated by the limitations of existing monetary policies and the growing discontent among citizens. The struggle to navigate inflationary pressures while maintaining credibility poses a significant dilemma for central banks. As we move forward, it is imperative that we engage in thoughtful discussions about the future of money, the role of central banks, and the importance of sound fiscal principles. A reassessment of our economic systems is not only timely but necessary. We must advocate for transparency and accountability from those in power, fostering an environment where citizens are informed and empowered to participate in shaping the economic future. Only through collective action and a commitment to sound economic practices can we hope to build a more equitable and sustainable future for all.